I get this question a lot. How do I know which fair value gap won't fill in? Okay. If we were in a classroom and I said, okay, raise your hand if you don't know when to do that. Most everybody would probably raise their hand. And I get that same type of thing in the comment section. They'll say, how do you know that that fair value gap doesn't or won't likely close in? Like, what gives you that discernment? What makes you say that you can trust that? Well, we've consolidated like this here, and my attention was around this level here. Not enough to take a trade, but I wanted to see, does it repel this and start to break down? Before I go any further on that, if it would have started to break down, I would have dropped down into a 15-second chart, used the fair value gap, and outlined that down into the level I was looking for over here and then here. But it didn't give me that retrace back to it and break down because we're looking at it on a 1-minute chart. Then I could drop down to a 15-second chart and then use that and teach on the price delivery continuum theory. So all that means is, it sounds like mumbo jumbo, but it's basically understanding one time frame and then breaking that run that you see beginning on one higher time frame, in this case the 1-minute chart. I can drop down to a 30-second, a 15-second, a 5-second chart and find multiple entries in that delivery while that price run is unfolding. You're getting lots of opportunities to get involved in that move and still not technically be chasing the marketplace. But there's a threshold at which you got to stop. And if you've seen my lesson on pyramiding, when to stop adding to the trade and making it larger, it's the same premise there. Okay, so you'll see me teach on it. I know some of you are going to get mad because I didn't say it again, but I'm trying not to be too redundant, but there's enough redundancy here to prove that it's the repeating phenomenon in logic. But why did I talk about this staying open before going up into this area here? Because we've traded above the consolidation, all of this right here. Let me do it like this. All this price action here. We've traded higher since 9:30. Here, up, back down, trade higher, consolidating. Okay. I don't like these kind of days, and I would rather wait for more information or do nothing, because on a day that's showing me that it's not trying to gyrate around too much, it's small and compressed. It's a lot of stagnant price action. Whereas when it does finally move here outside of that range, we had the stops below here taken out, as I mentioned, and then we traded above the high. Okay, wonderful. Once it does that, that means we left this consolidation. Did we lead the consolidation after a stop hunt? Yes. So that means once we're outside of this range, and if we have a fair value gap, those tend to be left open. So what does that mean? You can feel, not today, not on a day like this, but you're going to see me talk about it on other days where there hasn't been a big PPI number or CPI number or something to that effect, where we move outside of a range and we have this same element here. This is something you can go back and look at your old charts. Maybe it's a trade idea that you lost on, or maybe you missed a move, or maybe you didn't know what the market was going to do, and you can go back and look at your old charts and see this here, and you'll see that they stay open, not all the time, but most of the time. If it's something like this, then you anticipate them staying open, and you have a target up here that you think is going to draw price to, you can put this candlestick's low, your limit order, right at that candlestick's low, because then it only takes one tick to get below it to fill you long, and then aim for your target. Now this is like a bread and butter type setup where it's not a whole lot of movement, it's not a whole lot of range, but you can see we did trade all the way to the top of that volume imbalance on the daily chart. So this one, for the purposes and exercise of logging it, you want to make sure your charts all the way over the whole real estate of your chart. You don't want to have your charts like this, Caleb, because if I start seeing it, it's going to drive me nuts. The whole chart from the beginning of the move down here to the target, and make sure your chart is really filled up and it's showing you a nice range that we can see the prices over here, and it gives you lots of places where you can write and annotate. Okay, but when it's open like this, you can use institutional order flow entry drills, which is a partial entry into a fair value gap that you believe strongly is not likely to completely fill in. Now, You will see these setups form, and you will enter with institutional order flow entry drill as your entry model, just like um, any other model, any other entry technique. Okay, but it's a very specific element of anticipating fair value gaps that you believe will not close up or fill in like in here. So if you see those, and I talk about many times in my examples, either audibly in like a review or when we're watching recordings or tape reading, you'll hear me say, I want to see this stay open. When I was doing Twitter spaces and I was calling every individual 1 minute candle, I'd say, note candle at 10:47 a.m. 1 minute basis. Okay, NQ. And then I'd say, I want to see that one stay open or remain unfilled. That's the equivalent of me saying when we were watching it live down here, I want to see this one stay open. I don't want to see it fill in. And it doesn't. Okay? That proves there's logic there. That means there's something behind what price is doing that's causing me to say those things. It's not me just pulling shit out of my ass and just saying, hey, I want to talk and hear myself talk. I'm drawing your attention to something that I know with experience will most likely present this. Okay? Contrast that with all of everything else that was going on prior during the beginning of the stream. I was in observation mode. I want to see this. I want to see that. Because if it does this, then I'll have more information. I have no hard line fast. This is what it's going to do. And from here to here, that's all I would expect for Caleb. That's it. And we waited until 10:52, which is inside the macro for 11 o'clock, 10:50 to 11:10. There's going to be a run on liquidity or a run to inefficiency. I'll walk you through that macro before I close this one. But the idea is you want to see where does your attention jump to. Even if I'm talking about price action and I'm referring to something, your attention may go right to something else that I teach, like it's an order block, a stop run, like this here, institutional order flow entry drill. For students of mine that know what an institutional order flow entry drill is, like my private mentorship students, as soon as I outlined the fair value gap, you probably already saw that before I even started mentioning it. But anytime I say a fair value gap or an imbalance should stay open, what I'm saying is this is for your notes. If it's something that's acting as a premium array, meaning that it's trading up to it, which is the opposite of this, because we traded up and we're trading back down into it. The most sensitive area in that fair value gap is going to be the midpoint to the high of it here, which is this candle's low. So even if it did trade down into it, if I'm wrong about it not staying completely open and it trades down to the low, it matters not, because I'm going to get filled either at that candle's low or just above the consequent encroachment or midpoint between the candle's high here and the candle's low, so halfway in between. My fill will always be in that area. I am never trying to get a fill at the low end, because I have seen many times that the market won't go down there. Or if it goes down there, it won't fill me because of the spread. So I'm not trying to frustrate myself. So I want to get in with the low-hanging fruit opportunities of entry, the low resistance barriers to entry. That means the easiest one that the spread won't be a factor for. I won't have to be perfect. I don't have to demand precision. Okay, to me, this is precise enough. Knowing that if I believe that this gap is going to stay open and have some measure of openness that's not completely filled in, what am I saying by default? I'm saying that halfway between this candle's low and this candle's high, halfway point, which is consequent encroachment, it's going to go no lower than one tick below consequent encroachment, meaning that I have to find a fill if I'm going to go long at that midpoint to this candle's low. There's nothing wrong with going one tick as your limit order above this candle's low. Also, that really assures that even if you just book this price low, chances are you're probably going to get a fill. Worst case scenario, if it goes one tick below it, then you should have no problem getting filled. The lower portion of that gap, I'm not interested in seeing it trade down there. But guess what I'm doing? I'm affording myself the flexibility, should it do so, it would not freak me out if it's a day where I'm willing to be long. Okay, so Caleb needs to determine if he's going to use the low of that candle when there's a likelihood of a gap not filling and it trades down into it. Okay, the best fills are going to occur at the midpoint, which is consequent encroachment, to the high of that gap. And the least probable fill is going to be in the lower half because you're probably not going to get filled. Why? Because this gap formed after leaving this consolidation. So therefore, this gap should behave, it should behave as a breakaway gap. It's breaking away from this consolidation. See, but the folks that listen to me or watch what I do, they think it's either supply and demand because I'm drawing rectangles and over certain specific candles, and it's not supply and demand because supply and demand is a fucking myth unless we're talking about commodities, because that's a real thing. That's a grocery store of the world. There's real supply and demand factors in that market, but everything else is, it's not, it's supply and demand. It's controlled. It's controlled. Now, I guess to some degree commodities are controlled too, but there's real supply and demand factors with commodities. There's really no need to be buying a share of stock. There's really no need to be buying gold. It's a perceived form of money, but that's getting ready to be zero too. You know, when the Lord comes back, and I know you don't care to hear about this, but he's coming back soon. When he does, your silver and gold is going to be cast in the street because it's not going to save anybody. Wealthy people in the last days are not going to be comfortable. They're not. Okay, that's why I plan not to be here. So watch my personal YouTube channel if you want to know more about that. But this leaving of that consolidation, you're breaking away from that. If it's not supply and demand that people say I'm trading with, they're saying that I'm trading support and resistance. So if this is the resistance here, why didn't it come back down and touch it? Because it's not support and resistance that makes markets go up and down. The elements of this inefficiency, identifying it, as I mentioned in the live stream, you'll be able to record, not record, you'll be able to rewind the stream when it's done. When the session's ended, within 5 minutes or so, usually I have to grab a drink or something, then I'll go into the settings and I'll add it to the playlist for 2024 mentorship. If you have bookmarked the playlist, every day when the live stream's done, you can find that live stream that was made that day in the playlist in the order of their production. So that way you can go back and listen to everything and do all your note taking and whatnot. But the breakaway gaps, okay, when I'm referring to anything like this where it's not likely to fill, that's your key. That's your, like, okay, that means institutional order flow entry drill. Okay? Unless I say that this gap should stay open or unfilled, you're never looking at institutional order flow entry drill. That's not the go-to. Now, let me backpedal just a little bit for the folks that like this idea, because you might think, okay, well, I'm going to use that as my entry technique, and even if it's a fair value gap that I may not say I want to see it remain open. There's nothing wrong with that per se, if that's your entry model. If I'm building a position and say this gap is larger, okay, say it's a little bit wider, I will use institutional order flow entry drill as my first entry, 6 contracts long, and it may dig down into consequent encroachment or the upper quadrant, and then I'll add 4 more. And then if I really like what it's doing in there, or if we enter in between, like this, say it goes in at 10:47. Say this time was 10:47, and then at 10:49 it went down into consequent encroachment, and then at 10:51 it trades down into 1 tick below consequent encroachment. I'll add 5 contracts on that one, even though I'm underwater a little bit on the 6 contracts, and underwater maybe a tick or 2 on the trade that I added 4 on. That would be 10 contracts. Then I can go in with a 5 lot when it goes to 1 tick below consequent encroachment, with the same assumptions that this lower portion is going to stay open. I've built in a position, okay? But what I just described, you won't be able to do that with one particular funded account company. Like, you can't add, they call that averaging in. And it's just building your position. You can you can avoid that by just simply not doing this type of trading. Just do one entry, use your institutional order flow entry drill as your only entry, and then add your trade, pyramiding in at a higher place. Okay, like this order block here, this order block, and fair value gap here. All those subsequent later and higher PD arrays. You can participate with that particular fund. You know what I'm saying, what company it is. I'm not going to mention them here because I don't want to sound like I'm an affiliate or repping them. And the only reason why I brought up Top Step is because Caleb said that's the one he's going to use. Okay, so it's not that I'm trying to funnel anybody there. That's not the point. But I'm sure they're probably tickled that I'll keep mentioning them. But, if he has a bad experience, you'll hear about it. So the institutional order flow entry drill is more specific to when we like to see a gap stay open. So if it does get below that low and enters into it, the underlying assumption is that you think that this is going to somehow remain the lower half open. Okay? Some portion of this gap between these two candles isn't going to be completely overlapped with sell side delivery. That means the market moving lower. If this is not your cup of tea and you can't see that, okay, then you would be trading order blocks, okay, and that would be this candle right there, and that candle right there, and that candle right there, because all three of these candles are all one order block, meaning that this order block, it's not just the last down close candle before the run up. These three consecutive candles are trading back down into this gap that has already been primed to send price higher. And we're just getting one more visit here. And then it trades above it. And it comes right back down and digs into this entire range here. See that? So if you look at it like this, can you tell I'm having fun today? I was supposed to get out of here at 10:30. What time is it? It's almost noon. I had some people complaining, can you make your videos shorter? I can't watch all this. I can't help you, man. Go watch somebody else. Go learn from somebody. Go watch the 5-minute trainer people and never make any money, never learn how to do it. This open price, all part of these consecutive candles, okay, that open price is the change in the state of delivery. That means the algorithm sees these three candles and goes right to that opening price. What makes these three candles the order block is because we have a fair value gap down here. The momentum is shifted higher. This should stay open, trades down and touches the top of it, and starts to move higher away from it. It does so. Okay. When this candle's open price, when that is breached, that validates this order block. Think about what I taught you yesterday in the live stream, how my entry mechanism was for the initial entry in 6 contract short on NQ. The same logic is being shown here, just reversing it. Now, look at that opening price through all of this back and forth price action. See that? I'm not supply and demand. Okay, I don't give a shit what anybody else says. Sam Seiden seems like a pretty nice guy. The few video clips people sent to me said, you took this video. Bullshit. This is not supply and demand. I'm cutting through candles. I'm labeling an order block based on a supporting PD array. It's not a be-all standalone type thing. It's never, an order block is never an island of unto itself. But when you watch these multi-level marketing shitheads, okay, these 20-year-olds that talk like me, they talk like me, and they promote these ideas and understandings that are incomplete because they don't know what the fuck they're talking about. See, there we go again. Let me dial it back in. Forgive me, Lord. I'm trying. When you have this opening price, you want to extend that to the right and then study how price respects and deals with it. The wicks are always allowed to do the damage, but look what the bodies are doing. The bodies are staying in the upper half of the bodies. The bodies tell you the narrative. Okay, so if you take that range and still like this, let me make it a little bit taller so you can see what I'm referring to. You're getting lessons on order blocks and didn't even ask for it today. Some of you asked for it, but that's not why I'm doing it. It's just I feel like teaching today. So we have the body on the open down to this close on the lowest down close candle. That range, okay, that range is where the narrative is going to be seen. You're gonna see what, if this is an order block, these things I'm going to show you right here, they're going to be present. Okay, extend that forward. The body stops right there at that open. But what does the wick do? Trades down. This candle's an up close. It doesn't matter. It doesn't mean anything. This candle trades down into the open plus a tick or two, and then trades higher. Then we trade down again. What is it doing? It sends the body into the upper half between that candle's open and this candle's close. That red line. Look at what's going on there. Where are the bodies of the candles? Any down move back into that range, where are the bodies? They're in the upper half. So you don't have to sweat picking the best entry. If you know what my order blocks are, and you really won't know everything about them until the books come out.